Good morning and welcome everyone. One moment while I just get my guests up on stage. Cool, they should be popping up here. Welcome everyone. Today we've got a awesome webinar. We've got some great guests up on stage with me as well. We'll just wait for Sammy to get her camera on. Cool. So I'm joined by Samantha Cairns-Morrison from Opes First Home and Peter Norris from Catalyst Financial. Now I might be biased, so I'm pretty excited for today's webinar because I am trying to buy my first home this year and I want to hear all the advice I can possibly can. But also for our real estate agent audience and property professionals, I believe this one will be a good one, just so you can understand more about the process and what some real life experiences are being a first home buyer if you're working with them closely. So it could be awesome for that. And just because there are quite a few changes and unknowns that I've experienced so far. So yeah. Before we get into it, my name's Stacey. I'm the Sales and Marketing Coordinator at Relab, and just a few admin things. We do have Lou, our CMO at Relab, here on the chat bar. If you've got any technical issues or general questions, she can help you out. And also chuck your questions in the chat channel as we go along, and we'll get to those at the end. Awesome. So to start off, thank you, Sammy and Peter, for coming on today. Do you both mind introducing yourselves a little bit? Tell us how you've got to where you are and what you do.
Sure. You go. Oh, no, I'll go. Hey, I'm Sammy. I run Opes First Home. I guess I got into this business because I'm the ultimate first home fail. I had a terrible experience buying my first home, and I just thought it could be done quite a bit better. So I've got a development sales background, and I genuinely really enjoy helping people get into the market. It shouldn't be as difficult as, I guess, my experience. So yeah, learn from my mistakes and happy to help.
Cool. So my name's Peter. I run the Catalyst Financial. So we're mortgage insurance investment advisors nationwide. We've got a team nationwide, and so my background is I've been mortgage advising for 12 years now. I finished up school, went to BNZ, did all that, left BNZ, and then started a mortgage brokerage and sold that into Squirrel, and then was there for a little bit, and then left there beginning of last year and jumped into Catalyst, which is alongside Opes as well. So we work really closely with the Opes team on the first home buyer side and the investor side.
Awesome. Cool. Go right into my questions. My first question is because I've just from personal experience starting the process, I thought I was in a decent position, but then a whole lot of barriers come up that I totally did not expect. Like a mortgage broker I was talking to told us don't even bother with existing properties at the moment. Like the bank just won't give you money for that. So that kind of set us back a little bit. What are the main barriers to entry that you see that are often missed with first home buyers?
You go, Peter.
Cool. So the first home buyer space has been, and the investor space has changed a lot, right? In terms of the banking environment. So I think it's been, since 2015 when the LVR restrictions come in, or the banks have sort of changed rules around appetite for low deposit loans, or sort of what they want to be seeing. And so over the last little while, you've seen banks really pull back from low deposit loans, and pretty much all of them in the last 3 months have sort of still 3 to 6 months have sort of said that they won't do any low deposit lending. And so that's been a pretty big hit for the first home buyer market. That started to change now. So we're starting to see banks come back in. They're really looking after their own clients first and foremost, but they are starting to say yes to low deposit lending, although you really do have to have strong servicing. And so in terms of answering your question in terms of what's missed, it's I think it's a lot of first-time buyers get stuck in sort of what they see in the media, or they go to their existing bank and the bank says no, and so they kind of get a little bit disheartened. The big thing to remember is that banks are still lending, and there's other options as well in terms of your non-bank space as well, which can be really, really good for both first-time buyers and investors. So I think it's not getting too disheartened and sort of making sure you're getting the right advice.
Yeah, I'll jump in there as well, and just I think there's a lot of mindset around it as well. So I'm finding a lot of first home buyers, and all of us are guilty of this, I think, to some extent, is that we're wanting to find our forever home, and it's not necessarily the right way to do it. So look, your first home's never going to be your forever home, or it shouldn't really be your forever home. You might not even love your first home, but you do need to get on the property ladder, and your first home should make you money. So we're quite, and it's a little bit of a defeatist way to look at it, but really it should be making you money, and it should be a stepping stone to your forever home or to your dream home. So, you're a couple of steps away from getting something that I think you can see yourself in for 10 years. But if you get on the property ladder with something that's priced at or below value, so you can then turn it into either an investment property or, get your capital gains and move on to the next step in a couple of years, that's a really positive way of looking at it. So it might be smaller than you originally wanted. You might not have the big backyard, but you're on the property ladder. So we do see a lot of the time people are waiting and they're missing out, and they keep thinking the deals are going to get better. And that's quite a heartbreaking thing to see, for people waiting and continuously missing out.
Yeah, I've heard from so many friends being like, oh, I should have just done it when I first tried, because they're looking at the market now being like, oh. So we briefly mentioned, Peter, you briefly mentioned this just before, but how strict are banks being at the moment, and can we expect any further changes?
I think these days banks are very changeable in terms of their appetite, particularly in that low deposit space. Not really unique to first-time buyers or investors. I think that both of them have taken a bit of a hiding in the last little while from banks in particular. So as I said, pretty much all the banks are back in the market around that low deposit, so you can get away with up to sort of 10%. I'm talking existing properties. New builds are exempt from all those restrictions, so all the banks are open to new build low deposits, and that's the same for investors and first home buyers. So all the banks are open in that space. So I'm sure we'll talk more about that later. But in terms of the bank's appetite for low deposit lending, I'm talking from a existing property perspective. You can get up to 90% borrowing, which is great. The negative is, say, someone like an ANZ requires really, really strong, like obscenely strong serviceability, much stronger than what we would usually see from a first home buyer. So whilst they're back in market, it's actually really difficult to get. But that's unique to them. And then ASB and Westpac are sort of in the market as well. But again, your servicing just needs to be stronger. But the big thing to remember is it's not all about the main banks these days. There's actually a lot of other lenders in that near bank space that are actually really competitive in the low deposit area as well.
And can I jump in there as well and just say, look, we've actually had, Peter's helped me out a lot with a couple of clients that have not been able to get it across the line with the bank. And we've just got quite creative with the non-bank space, and they've all gone ahead. So it is just, I guess, about going to the right. I don't want to do too much of a plug here, Peter, but going to the right broker and making sure that you're exploring all of your options. So I've had a couple of clients who've just literally come back to me in tears saying, look, the bank said no, we're not quite there, we're missing 4 or 5%. And we've actually been able to turn that around and get them into their first home. Every single one of them, we've been able to find a solution to get them into their first home. So it's just, I think, about making sure you've got a really good broker and making sure that they are exploring all the options for the client.
Cool. And going back to what you said before, Sammy, about not finding a forever home, I think, well, what I've seen a lot is people want a certain thing, and they don't really explore any other options. What are the different types of properties that first home buyers should be considering?
Yeah, look, obviously the dream is to get a little cottage with a backyard. And that's great. We just don't recommend that as your first home. First of all, price is just not realistic, especially in the Auckland market at the moment. You're going to be paying just too much, and it's not going to be something that you'll be able to easily service either. A new build has got a lot of really good benefits. You've got your maintenance for the next 10 years is pretty much minimal, which is great. You're moving into a brand new home. It's all to healthy home standards. It's a really easy one to, lease out if you needed to turn it into an investment property afterwards as well. So townhouses, I'm a firm believer in townhouses. I think the value is fantastic. The price, I think, is still a really, a realistic entry point. And if you're looking for a townhouse development, there's a lot of them out there now that have got a lot of really cool communal space. So you're not getting as much of a backyard, but you're getting a really cool village type feel. You've got, shared park space, barbecue areas, etc., etc. So you are still getting a lot of the benefits, but it's just been done a little bit differently than having your own big backyard space there. I was talking to a developer the other day, and they said they always tell their buyers that traditionally, we're wanting a 3-bedroom, 90 square metre house with a big backyard. Land price is so expensive in Auckland now that what they say is they've just flipped that house on its side and utilise the free airspace. So it's still the same size. You've still got a 90 square metre 3-bedroom house, 2 bathrooms, but we're building up instead of building out. So you're not paying that crazy amount of money for land space. So yeah, that would be my biggest favourite property would be a townhouse, I think. A townhouse in a really solid development.
Awesome. And with those new builds, what are the key things you need to consider before making a decision? E.g., like talking to the developer, like doing your research.
Ideally they'll have it's all about look, touch, feel, go on site, see what the showroom's looking like. If you can, you'd be going through one of their previous properties and checking out finished product already. Another thing to kind of think about as well with a new build is look around the area for other new builds and what, if you wanted to turn this into a rental later on, what they're renting out for, what sort of returns they're getting. I think it's definitely key to do your research on the developer. If you come to a company like us, not trying to give us another plug or anything, we do a lot of research on the developer before we decide to partner with them as well. So that's quite important as well, doing your research on the developer, seeing what they've done in the past, seeing what their build quality is like. That's going to give you a lot of peace of mind going forward. But yeah, ideally a showroom or having a look at their previous work.
Cool. And a question probably for Peter. Can you talk us through the benefits of having a 20% deposit versus a 10%?
Yeah, cool. Other than the obvious, where you borrow less money. The main thing around that is your cost of borrowing is going to be cheaper. So banks, if you're able to get a loan where you've only got a 10% deposit, so 90% borrowing, they're going to charge you a little bit extra for that. Some banks have a low equity margin, which is where they add an additional margin on top of your interest rate, and some banks have a low equity premium, which is like a one-off sort of fee that gets factored into the loan as well, which can be quite onerous. Whereas at 80%, you're going to get all those special rates. You're going to get the cashbacks. You're going to get all those incentives of borrowing, of having a bigger deposit. So that's the major sort of factors. It's just that price is going to be cheaper with a bigger deposit, and also it's easier to get an approval. The amount that you can borrow at 80% will be higher than what you can borrow at 90%. Just because of the way the serviceability and how the banks work that out.
Cool. And what I just learned from a Opes webinar as well is that there is an option to use equity from a parent's home, which I had no idea that was an option. Can you talk us through that a little bit?
Yeah, cool. So the bank of mum and dad is sort of how that's termed these days, and it's actually really, really common these days. It's quite hard for a first home buyer to get into the market without some sort of help. So we probably see, of all the first home buyers we deal with, I'd say 70 to 80% of them would have some sort of help from parents, whether it be a cash gift or a deposit or a loan or using equity. And so there's a couple of ways that you can use parents' equity. They can either come on as a guarantor, which would be my least preferred option, mainly because the parents actually end up guaranteeing sometimes more than what they actually need to. And so it puts them on the hook for a little bit more. And also, once you release a guarantee, that actually stays in place for a couple of years after it's been released. So the parent stays involved longer than they actually need to. But it is still a great way to leverage parents' equity and help out with the loan. And it brings that, whilst you might only have a 10% deposit, it brings that equity down below 80, which can benefit interest rates and that sort of thing. And the other way to do it is where you sort of actually top up against the parent's house and then gift that across to the kids or loan that across to the kids. And in that way, the parent's liability is very much limited to whatever is actually against their property. Same outcome, just limits the parents' exposure, which they've worked hard their whole life to get to their position to be able, where they can help the kids. So it's important from our perspective that we also protect the parents as well as get the kids into the house.
Yeah, perfect. And what are the key things to remember when using Kiwisaver for a deposit?
Were you going to go, Sammy? Oh, look, I'm the biggest Kiwisaver fan out. But the things that I guess to consider, and obviously this is probably more of a Peter question, but just that you do need to live in it for 6 months. So people get a little bit confused about that. I've actually had a lot of clients confused about the timeline as well of having to be a regular contributor for at least 3 years and having to keep $1,000 in there as well before you're able to access it. I think Kiwisaver is a fantastic option for your deposit, but you just have to be super aware of the rules around it. I've had quite a few clients caught out by those rules. So yeah, but it's a great option for buyers, especially if you're putting down. I've got a lot of buyers who put down the initial 10% for an off-plan new build, and then they'll use your Kiwisaver when they've saved a little bit more towards the end at settlement, and that's a great option to do. They now have a really good savings plan. They've got a timeline, and they'll withdraw at the very end for settlement.
Yeah, and the other one is I had a client asked me the other day if they were buying off the plans, did they have to use the Kiwisaver for the deposit, or could they use it at the settlement, which is sort of talking to what Sammy's just said. So you can use it for either deposit, so at the time that you go unconditional or at the time that you are settling. And so it really depends on whether or not you think you want to keep contributing to build up that deposit or pull it out early to pay. And then the other ones are obviously the first home buyer grants and that sort of thing. If you can manage to find a property within those limits, then, which Sammy's good at, then you can actually get access to those government grants as well, which is certainly worthwhile. Yeah.
What are those limits? Because I know they're quite a bit restrictive.
Yeah, that I've got a love-hate relationship with this. I mean, it's nice. It's up to $10,000 each, which is great. I mean, 20 grand is a lot of money for nothing. Having said that, you have to buy a house in Auckland for under 700. So that's a very big barrier. The income cap's not too bad. It's 95,000. Correct me if I'm wrong, Peter. It's 95,000 for an individual, and I think it's now, is it 150 for a couple? So the income caps are not too bad, but it's
dropped down a bit there.
Sammy, get some better internet.
Oh no.
You put me on the spot. In all honesty, I'm.
I know.
Not a specialist in terms of.
No, I'm not. Sorry. Hello.
Oh, it's a bit touch and go. Sammy, it's looks a bit like a robot there.
Sorry, guys. Me and technology, it's not the best thing.
No problem. Okay, so my last question before we head over to the audience questions, just to kind of sorry,
just carry on asking me.
I'll leave you
what are the
to answer those
biggest
mistakes
mistakes
I don't know if anyone's going to hear
buyers?
Me. I don't.
Yeah.
Sorry, Stacey, carry on.
Yeah. So, Peter, what are the biggest mistakes you see with first-time buyers making?
Oh, I mean, the media's sort of thrown a lot of spenders in the work lately with all the talk around sort of banks analysing your spending and trips to Kmart stopping you from being able to borrow money and all that sort of stuff. And like things have changed. Borrowing money these days is probably harder than I've ever seen it.
Yeah,
Sorry,
can
guys.
So borrowing money now is definitely harder than it sort of has been in the past, and to a degree, what the media is sort of saying is correct. But and on that path, I think that one of the mistakes that first-time buyers can make is just not being ready and sort of jumping in before they are actually ready. So I think it's really important to get all your ducks in a row and make sure afterpay, things like that. Get rid of that for 3 months before you apply. Credit cards, can you limit how much is on that? Things like hire purchases, personal loans, all that consumer debt stuff. Can we get that down as much as possible? And just get things and go and talk to someone before you're actually ready. Like come and talk to us and say like, okay, what's my position now? Where do I need to be in order to apply? So that one of those mistakes can just be jumping in. And the problem with jumping in too early is you get a no and then you get disheartened and kind of takes you a while to go back. And then the complete flip side of that is holding off too long, right? It's just not having a go. So, and sort of thinking that, there's talk in the media. Last year was all about property prices booming and it's a seller's market, not a buyer's market. And so everyone holds back and goes, oh no, it's getting too expensive. And then this year, everyone's going, oh, the market's going to drop. I don't want to jump in while it's dropping. And so if you just kind of sit and wait for the right time or try and pick the market, then you're never going to get in. And so whilst there's one side that says, make sure you're actually ready, there's the other side that says don't just sit back and not do anything, like actually have a go and talk to someone and actually get ready.
Cool. Sweet, we'll head over to the audience questions. One from Lou. Given the Reserve Bank is set to continue moving on the OCR in the next few quarters, what sort of interest rate rises do you think the banks will respond with by the end of the year?
So a lot of if you read most of what the economists say, or you listen to what the RBNZ said last week at that OCR announcement, was that their expectation is that the banks have already factored in a lot of these increases already. Now, I still think you're going to see increases, like the OCR increase 0.25 last week, and then you saw a flow-on effect where the banks did lift some of the fixed rates by sort of 0.1 rather than
if you can hear me, I'm not quite sure if you can, but I also think
they've dropped out.
Yeah, cool. So look, I mean, interest rates are crystal ball gazing in terms of what's going to happen. But my view is that I don't think you're going to see 1 year rates, like the short-term rates, get as high as where sort of the 3, 4, and 5 year rates are now. Like I don't think that a 1 year rate in a year's time is going to be 4.9. I think you'll see sort of low fours for those shorter terms, sort of, and I'm talking 1 years, and then obviously the 3, 4, and 5s have pushed out further as well. But I do think that the banks have already started factoring in those interest rate rises, or the expectation that the OCR is going to increase.
Cool. And from May, how much should you be looking at to spend on a townhouse? The prices of townhouses in Darwin are the same as full homes most times.
That's probably a question for Sammy.
Yeah.
From what we're seeing, I mean, we've run some seminars and webinars around the difference between townhouses versus standalone houses versus apartments and the long-term capital growth, and whether there actually is a real difference. Look, I mean, generally speaking, a townhouse will be a little bit cheaper. It's more affordable. That's why there's more first-time buyers leaning towards those. So we are seeing a lot of new builds being in that townhouse space rather than standalone. Standalone is typically going to be further away from town. Like if you think about Auckland, for example, or somewhere like a Christchurch, those standalone houses are a bit further from the main centre because that's where the land is, whereas the townhouses or the intensification is happening closer to the city. So it depends a little bit on where you want to be, but also what you can afford.
Yeah. Sammy, can you, are you back to normal now? Or?
That's no.
Not sure. Okay, I'll move on. How are banks with lending for new apartments, and thoughts on apartments versus townhouses?
Yeah, so apartments is probably, from a bank perspective, one of the policies that's quite volatile. So banks come and go from whether or not they want to lend on them, what size they want to lend on them. The magic number is sort of 50 square metres. Anything over 50 square metres, and typically you should be all right getting finance on it. There are a couple of banks that will go down to 40, but again, like I say, it's a little bit volatile. So if you're in that space, you're not necessarily guaranteed that every bank's going to lend on it. Off-plan apartments, so if you're buying new builds, then those apartment complexes tend to be 2, 3, 4 years away rather than within the next 12 months. And so it's quite hard to get an approval. In fact, it's impossible to get an approval for that property. So you need to be careful of things like sunset dates, who the developer is, how much deposit you're paying and all that sort of thing, because you're not going to be able to get an approval. So you're taking an element of risk buying those. Not to say that it's you shouldn't do it. It's just want to make sure that you understand the contract that you're getting into. In terms of my own view between apartments and townhouses, I strongly lean towards townhouses. I've owned both, and I just think that the townhouses, if you're getting something like a freehold title, or you're going to be better than a body corp within an apartment complex. It can be quite expensive, and you're going to get better long-term capital growth from a townhouse than an apartment. So my personal view is definitely a townhouse between those two.
Are there any differences between like a new build townhouse and one that's pre-existing?
Well, from what perspective, in terms of?
Like something that's, you might get the benefit of having like less maintenance, but if it's not within like the new build status, is there less benefits in terms of?
Well, I mean, so the benefit of buying new, the immediate benefit is the things like low deposit. There might be a master build guarantee attached to it. There might be a 5-year bright line test rather than 10-year bright line tests, or all the benefits that have come in through this government, and the tax changes if you're buying an investment property, that sort of thing. So buying new has, in the early days, all those benefits, whereas if you're buying an existing, then you potentially need a bigger deposit, or you may not have those same guarantees, or there may be a little bit more maintenance or that sort of thing. But it depends on how old the townhouse is, right? Because you can buy one from last year, it's still new.
Yeah. Okay, cool. And from Anjali, to get into 1 million house, what kind of deposit and income is required? No debts. This is quite a broad question.
Yeah. So from a real simple way of working out sort of how much you can borrow. So the question in terms of what kind of deposit is required is, black and white would be 10% or 20%, depending on your situation. So either 100K or 200K or somewhere in between that. But then that's on the assumption that you can borrow 800,000 to 900,000. And then reverse engineering that is, if you've got no debts, which Anjali says no debts or none of that, so let's assume that's correct, then you're probably pushing towards that sort of 7 times debt to income ratio that you can borrow. So if you're borrowing borrowing 700,000, then 100,000 of income, but that's probably the upper end. ASB's debt to income ratio is 6 to 7, BNZ's is 6, and then the other banks sort of operate somewhere in between that, depending on how they calculate your expenses and that sort of thing. So broadly speaking, and don't hold me to this, but broadly speaking, good income, no debts, no major expenses, no afterpays, all that sort of thing, you're probably pushing towards more of that 7, maybe a little bit more than that, 7 times, and then the more sort of debt, student loans, things like that, you're dropping down more towards that 6 times. So hopefully that helps answer.
Yeah, cool. Yeah, I'm having trouble getting Sammy back on the call, unfortunately. So she's in the chat though. Carolyn made a comment here. Units give more space in apartments and including parking, but on cross lease. Whereas some new builds are freehold, but parking costs extra and homes smaller.
Is that more of a statement than a question?
I think that's more of a statement. But,
yeah. So it's not. Oh well, there you go. Cecilia's question kind of flows on from that. In terms of yeah, look, the townhouses are not always going to be freehold. Some of them can be unit titled. Some of them will have some townhouses, or depending on how the size of the development, will have a body corp attached to it. Some will have a residents association attached to it, which is quite common, similar to a body corp, but less sort of less expensive, but also less that comes with it because you've got that freehold title. And then Cecilia's question around assuming that a townhouse is a cross lease. No, not at all. In fact, cross leases are sort of being done away with. It's quite an old-fashioned way to separate a title, whereas these days it will be sort of freehold or unit title or stratum, or there's a few different ways that they do it. But a lot of townhouses will be freehold, but there is that difference between body corp, residents association, or none of the above. So it's just really understanding what you're getting into.
And Cecilia added, we are finding that cross lease properties on the same street are actually not that much cheaper than freehold. So would I be correct in preferring freehold titles?
Definitely, absolutely. Yeah, I mean, anyone you speak to would prefer a freehold title than a cross lease, definitely, because it's clean. Yeah, as I said, cross leases are being done away with a little bit. Well, actually entirely because of that. But so you won't see any new builds built on a cross lease title.
Perfect. Okay. Yeah. Cool. If there's no more questions, I think we'll wrap it up here. Unfortunately, Sammy's not there. But thank you, Sammy, for coming.
The opposite, I've been doing it from home.
Yeah. But yeah, thank you, Sammy and Peter, for coming on and answering all the questions. I'm sure everyone learned quite a bit there. And yeah, thank you everyone for joining us today. And yeah, we'll hopefully see you on the next webinar.
Awesome. Thanks for having me.
Thank you. Bye.